why the futures are up so sharply this morning. I'm not really sure why the market was down last week. It's hard to kind of pin this on anything and say, here's the reason, and this is why I can definitely get behind this. Do you have any answers to this?
So I agree with you, but think of a very simple tug of war. On the one hand, we have lost the drivers of improving fundamentals. The economic recovery is not as strong. And policies, it's clear that we're not going to get a fiscal policy response, and the Fed has lost control of its narrative. On the other hand, there is still a very deep buy the dip mentality because there is no alternative to stocks as it goes, and because you don't want to miss out yet again. So this combination of buy the dip, TINA, and FOMO is competing with the reality of weaker fundamentals and weaker policy support. The big hope, Becky, is we can keep it range-bound, especially on the way down, hoping that the policy response will improve in the weeks and months forward.
Both of those are very sound ideas. The idea that the fundamentals have weakened, we've got a lot of rough patches ahead potentially, but then this fear of missing out and the idea that there's nowhere else to go. That's the TINA thing back, right? There is no alternative. Which is the right side? What should investors be listening to a little more loudly these days?
You know, I've got a Financial Times article coming out of this, and the analytical side clearly says respect valuation, ultimately fundamentals matter. The behavioral side says this market has been conditioned so strongly to buy the dip that it's hard to resist those technicals. I think it really depends on your balance between being a tactical investor and a strategic investor. If you're a tactical investor, this is a wonderful environment for you. If you're a strategic investor, you've got to take a view. And for the long term, I often find that fundamentals matter the most.
I mean, that could explain the difference between what you hear from a lot of people who have been doing this a long time, who watch the markets and who get very concerned about this. I mean, some of the people who have made the best names for themselves have been very concerned, but they've been wrong for a while here.
Oh, absolutely. And I've been wrong. You know, in July, I've stepped back from the marketplace, just too worried about the fundamentals. You know, we're learning it's really hard to solve for an economic recovery that needs to be strong and can be strong, public health and individual freedom. If you're China and you can assume away individual freedom, it's easier to solve, and we're seeing China bounce back. But if you're Europe, if you're the US, it's harder. And I am in the UK right now, and I can tell you that the UK is starting to worry about a double-dip recession, and we're just out of a recession. So this is really hard right now to navigate through these three competing claims.
Yeah, and I guess on the other side of things, momentum is great, and it works really well until it doesn't. It can go away for no clear reason, and sentiment can change really on a heartbeat.
Yeah, you know, the image to have there is you're building a sand hill on the beach, and you build it, and then you start adding sand. At one point, it is a few particles that change the shape completely, and you can never tell when it is. And that's what makes it so hard. And I really sympathize with how hard this situation is. You know, the most important issue for investors is to avoid non-recoverable mistakes. Most mistakes are recoverable. It is non-recoverable mistakes that are really problematic, and that's about default. That's about capital impairment. So make sure there's a balance sheet behind whatever you invest in, because that's the one mistake that time will not heal.